Welcome to Money Minds. We're here to demystify the world of finance and help you make smarter decisions with your money. Investing can seem like a daunting task, especially for beginners. But worry not, because today we're going to be your guides on the journey to long-term investment success. In this video, we will explore the power of long-term investing and discuss 10 proven strategies that can help you grow your wealth over time. Remember, investing is not about getting rich quick. It's about growing your wealth steadily and surely. So grab your notepads, sit back, and let's dive into the exciting world of long-term investing. Did you know that if you had invested $10,000 in Amazon's IPO in 1997, today it would be worth more than $12 million? That's the power of long-term investing. Imagine the potential of having your money work for you over time. Take Amazon as an example. It didn't become a trillion-dollar company overnight. It took years of patience and belief in the business model. Investing is a long game, and the magic ingredient here is time. Time in the market, not timing the market, is what generates real wealth. Patience is key. It's about resisting the urge to cash out when you see minor successes. It's about holding on, even in the face of market downturns. It's about understanding that the journey to financial growth is a marathon, not a sprint. Investing isn't about getting rich quick. It's about growing wealth over time. So, how can you do it effectively? Let's explore 10 proven strategies. First and foremost, diversification is key to long-term investment success. But what exactly is diversification? Picture it as a safety net for your investment portfolio. It means spreading your investments across various assets such as stocks, bonds, real estate, and commodities. The goal is to mitigate risk. Why is this important? Well, the financial market is unpredictable. One sector may be thriving today and struggling tomorrow. By having a diversified portfolio, the downturn in one investment can be cushioned by the performance of others. This balancing act provides a safety buffer for your hard-earned money. However, diversification isn't about randomly picking different investments. It's a strategic process that considers factors like your financial goals, risk tolerance, and investment horizon. It's about finding the right mix that aligns with your unique situation. Remember, don't put all your eggs in one basket. Diversify. Secondly, consider implementing the strategy of dollar-cost averaging. Now, what exactly is dollar-cost averaging? In simple terms, it's a strategy where you invest a fixed amount of money in a particular investment at regular intervals, regardless of the price. This could be weekly, monthly, or quarterly. It's like putting your investments on autopilot. The beauty of dollar-cost averaging is that it mitigates the impact of market volatility. When prices are high, your fixed amount buys less of your chosen investment. When prices are low, the same amount buys more. Over time, this can result in paying a lower average cost per share. Moreover, dollar-cost averaging takes the guesswork out of deciding when to invest. It eliminates the need to time the market, which even the most experienced investors find challenging. So even when the market seems to be on a roller coaster ride, don't panic, just stick to your plan. With dollar-cost averaging, you're building your investment portfolio over time, regardless of market conditions. Thirdly, the power of reinvesting dividends cannot be overstated. But what are dividends? Simply put, dividends are a portion of a company's earnings distributed to shareholders. With most investments, you have a choice. You can either pocket these earnings or reinvest them. Now let's delve into the magic of reinvesting these dividends. When you choose to reinvest, you're essentially buying more shares of the company or fund. And as these shares grow and generate their own dividends, you're earning more from the same initial investment. This is the essence of compounding growth, where your earnings generate their own earnings. Imagine a snowball rolling down a hill, gathering more snow and growing larger as it descends. That's your investment when you reinvest dividends. It's a powerful strategy that can significantly boost your portfolio's value over the long term. By reinvesting dividends, you're essentially using your earnings to earn even more. Our fourth strategy is regular portfolio review. Imagine your portfolio as a garden, and like any good gardener, you can't just plant the seeds and walk away. You have to tend to it regularly, prune the overgrown sections, and perhaps introduce new plants. The same applies to your investment portfolio. It needs regular reviews and rebalancing to ensure it aligns with your investment goals. Over time, the value of your investments may change, causing your portfolio to drift from its original asset allocation. This could expose you to more risk than you initially intended. Regular reviews help you identify such shifts and make necessary adjustments. Moreover, your financial goals or risk tolerance may change over time, and your portfolio should reflect those changes. Are you saving for a down payment on a house, or are you now focusing on retirement? Remember, a portfolio is not a set-it-and-forget-it endeavor. It requires your attention and care. A well-maintained portfolio is a well-performing portfolio. Fifth on our list is investing in index funds. Index funds are a type of mutual fund or exchange-traded fund with a portfolio constructed to match or track the components of a market index. They offer a simple, low-cost way to invest in the broader market. Instead of trying to beat the market, you're working with the market. This strategy takes the guesswork out of investing, and it's proven to be a reliable method over the long term. Index funds can be a great tool for beginners and seasoned investors alike. Our sixth strategy is the buy and hold approach. This strategy is straightforward yet effective. You buy stocks or other assets and hold on to them for a long period, resisting the urge to sell when the market fluctuates. This approach is based on the belief that, in the long run, financial markets give a good rate of return despite periods of volatility or decline. It's all about patience and riding out market fluctuations. Remember, investing is a marathon, not a sprint. Seventh, invest in what you know. This strategy is a cornerstone of smart investing. It's simple, yet profound. See, every time you consider putting your hard-earned money into a stock, bond, or mutual fund, you're betting on the future of that venture. But how can you predict the future of something you don't understand? Imagine you're a tech enthusiast. You understand the latest trends, the key players, and the technologies that are set to revolutionize the industry. Naturally, you'd be better equipped to judge the potential of a tech startup or an established tech giant compared to, say, a pharmaceutical company. This doesn't mean you should limit your investments to your fields of expertise. It means that you should strive to understand the basics of any business or sector you're investing in. You should know what they do, how they make money, and what challenges they face. Knowledge is power, especially when it comes to investing. Eighth, avoid emotional investing. The world of investing can sometimes feel like a roller coaster ride, full of thrilling highs and heart-stopping lows. It's easy to get caught up in the excitement or fear and make decisions based on emotions rather than facts and analysis. But here's the thing, emotional investing is a dangerous game. When we let our feelings dictate our decisions, we risk making impulsive, irrational choices. Fear might make us sell too soon, while greed could lead us to hold on to a losing investment for too long, hoping for a turnaround that never comes. Both scenarios can lead to serious financial losses. The antidote to emotional investing is simple: stay objective. Base your investment decisions on thorough research and sound analysis. Remember, investing is not about chasing the next big thing or avoiding the latest downturn. It's about building wealth over the long term through consistent, informed decisions. Stay rational, stay objective, stay successful. Ninth, always consider the tax implications of your investment decisions. Taxes are an often overlooked aspect of investing, but they can significantly impact your net returns. Different investment types and strategies can have different tax implications. For instance, investments held for over a year may be subject to long-term capital gains tax, which is usually lower than short-term rates. Some investments, like certain bonds and retirement accounts, may offer tax advantages. Municipal bonds, for example, typically provide tax-free interest. Retirement accounts like 401, KIs, and IRAs often allow tax-deductible contributions or tax-free growth. Conversely, high turnover strategies such as day trading can lead to a hefty short-term capital gains tax. Thus, understanding these implications can help you craft a more tax-efficient investment strategy. Remember, the goal isn't just to make money, it's to maximize what you keep after taxes. So, when devising your investment strategy, keep the tax man in mind. Smart investing isn't just about what you earn, it's also about what you keep after taxes. And finally, our 10th strategy: seek professional advice. This might seem obvious, but it's surprising how many people underestimate the value of professional advice when it comes to investing. Financial advisors and investment professionals have years of experience, extensive knowledge of the market, and access to tools and resources that most of us don't. For beginners, this advice can be invaluable, helping to navigate the complexities of the investment world and avoid common pitfalls. Even for seasoned investors, a fresh perspective or expert insight can make a significant difference to your portfolio's performance. If your financial situation is complex, perhaps due to multiple income streams or a large number of investments, professional advice can help to manage these complexities efficiently and effectively. Remember, investing isn't about getting rich quick. It's about building wealth over the long term. Investing can be complex. Don't be afraid to seek help. After all, the goal is long-term success. Thank you for joining us on this journey through the 10 proven strategies for long-term investment success. We hope that these strategies have given you a clearer understanding of how to navigate the investment world and set you on the path towards financial success. If you found this video informative and helpful, please show your support by giving us a thumbs up. And remember, the world of finance is ever changing, and there's always more to learn. So don't forget to subscribe to our channel for more insightful content on investing and personal finance. Your financial success is our greatest reward. Until next time, keep investing, stay informed, and remain financially savvy. Goodbye for now, and remember, the journey to financial freedom is a marathon, not a sprint.